Good morning, everyone. I'm actually a bit of a hillbilly, and what I mean by that is subsequent to my career at RMB and FirstRand, I've retreated into the mountains of Stellenbosch, where I try and squeeze a bit of wine out of the high-altitude vineyards that we have over there. And what I'm trying to say with that is I'm not a professional speaker. So what you're about to hear from me, you won't get at the MBA classes or research reports or even in Claude or ChatGPT. And rather, it's what I do with mostly my own savings, is try and invest into the future. So I'm here today to try and tell you about everything, including all the mistakes that I've made. And what was interesting for me was, you apply your mind to each individual investment, was to look if there was any meta insights that I could gain out of it. And lo and behold, there were, and I'm here to tell you about it, warts and all, and hopefully you will find it interesting. So I was asked to talk about FinTech in Africa, and I suppose that's kind of a polite way of asking me to explain why so much of it doesn't work, and why the bits that do work look nothing like those things that get applauded at conferences like these. So I suppose I can save you the 35 minutes of suspense, and I can give you the whole argument in one line, and it's this. In this market, the constraint is the moat. The thing that looks like the problem is not only the business, but it's also what protects you from the competition. In other words, it's where the value lies. So if you get this right, you can spend your time watching your rivals fall into your moat. And of course, that never gets old. First, the graveyard. Most of African FinTech apps fail, and they fail in a very specific, very predictable way. So what happens is somebody builds a beautiful app for a smartphone that the customer doesn't own, that then asks for a credit card that the customer doesn't have, to solve a problem that the customer didn't actually have. It demos brilliantly, it looks great, it stands out at the pictures, and then it meets the actual market and quietly dies. So none of these failures are actually stupid. They were just designed for the wrong customer. Nevertheless, the market is real. And there's a customer that actually exists. Last year, more than $1.4 trillion flowed through 187 mobile money services or digital wallets in Africa. That's 27% more than in 2024. And it's about 2/3 of the planet's entire monetary mobile value and 3/4 of the world's mobile volume transaction volume. And it all happened just on one continent, which is here. 40% of sub-Saharan adults have an account, and for 1 in 5 of them, it's the only financial account that they have. So while we and regulators and people who are socially conscious are fretting about retail banking penetration in Africa, the money has actually already gone digital. It just didn't go to a bank branch, and it didn't go through a credit or debit card. So the payment rails are there, they're just not the payment rails that you used to. The typical customer is therefore not a customer with the latest smartphone, and certainly not somebody with a good credit record, because there aren't credit records. So in Africa, there isn't a typical customer. Africa consists of 54 countries, all of which are different, and most of which, even internally, are diverse. But if you're going to aim for an average, you should probably consider Nomsa Khumalo. She's lived in Khayelitsha for 22 years without a bank that would have her. She has 3 children, and her husband is unemployed. She doesn't get payslips because she works for cash. She has no proof of address because she has no written lease, and she receives no mail at her house. So the formal system simply had no way to onboard her, yet she does have a phone. She uses WhatsApp, and when data allows her, TikTok. In other words, she's with it. Now, her bank is the spaza shop on the corner. Its Lusaka terminal lets her withdraw money that her daughter sends from Joburg. She uses it to buy prepaid electricity, top up airtime, and settle bills. So the shopkeeper turns out to be her teller, and that same Lusaka terminal gives her access to business services and microloans. Now, NOMSA still deals mostly in cash, but the cash now moves. It's recorded, it's safer, and it's cheaper than the ATM queues that are the bane of a poor person's existence. Nobody built her a bank branch. They turned the shop that she already trusted into one. The African customer is young. In most of Africa, the median age is under 20. That means Africa's people are a growing labor force, a growing consumer market, and a tech-savvy, innovative, entrepreneurial population. Of course, what this means is that a continent this young has no legacy banking habits to unlearn. There's no checkbook nostalgia. There's no memory of parents with credit or debit cards. Whatever financial behavior, therefore, that you can make work on a phone becomes the default for the largest young population on earth. And as I said before, the branch network in Africa was never built by banks. It was built by shopkeepers. The spaza shop, the airtime kiosk, the tuck shop, the second-hand clothes and goods trader, the hairdresser, the woman selling vouchers from a cooler box. That is the distribution network. It already handles cash, trust, and credit in every neighborhood that the banks decided wasn't worth a branch. So the lesson here is brutally simple. Distribution is destiny. If you're in the shop, you win. If you try and replace it, you lose. So here's the whole talk in just one slide for those of you who'd like to leave for lunch early. The companies that work make 4 choices. 1, they don't build for the device they have, or the device of the future, or the device that they wish people had. They build for the device people already own, even if that is a cheap feature phone. 2, if you try to replace the bank, the mobile network operator, or the wallet, you're going to get murdered, perhaps literally. So don't. The FinTech companies that make it sit behind the bank, behind the mobile operator, or the wallet that provide the services. 3, Africa is hard, right? So you can complain about how cheap and unfunctional the phones are, or that people can't get credit cards, or that people never have data, or the bureaucracy is just so bad. Seriously, that may get you followers on X, but it won't get your business to succeed. If you want to succeed, you've got to treat these constraints as the moat, and not as an obstacle, so that others can't cross them or be bothered to cross. And then 4, the FinTech companies that work keep iterating to get the unit economics to make sense. Because in Africa, the tickets are tiny, and that only works if the volumes are enormous and your overhead is razor thin. So let's take each of these choices in turn, and I'll illustrate them with some of the companies that I'm involved with as an investor, a founder, or sometimes just as an advisor. So part 1, which is building for the device people already own, not the one that you wish they owned. Clickatel has been quietly right about this for 26 years. While everybody else chased the App Store, they bet on something called USSD. It's a clunky star hash menu that runs on every phone ever made, with no app, no data, no smartphone required. It's genuinely unpleasant to use, but it's also the only channel that reaches the entire continent at once. So what happened here? They turned the ugliest interface in telecoms into a banking channel, because it was the only channel that was already in the customer's hand. So ugly and universal beats elegant and absent every single time. So Clickatel kept making the same boring, correct decisions year after year. In fact, they invented the 4-digit SMS code, the one that WhatsApp now uses to verify new users, and they landed funding in Silicon Valley. They also enabled Absa Bank in South Africa to be the first bank available on WhatsApp. Their Transact platform is today the largest chat banking platform in Nigeria, covering 70% of the bank population. And in 2025, that same humble USSD shortcode is carrying a central bank digital currency, the e-Naira. So Clicketel enables these customers to access the electronic currency without even having mobile data. So they followed the same instinct every time. Don't make the customer come to a new channel, go to the one they're already on. The products changed, but the technological approach didn't. Nile is an interesting company that took that instinct to the logical end. All over the developing world, shoppable video is exploding. So what happens here is that content creators put videos on TikTok, Insta, or YouTube, and viewers can buy what they're selling without any friction. But all of these companies bypassed Africa because payment rails like Stripe or PayPal just don't exist in Africa. So African creators are getting views, but they had then to get people to ask for their banking details, and nobody had websites for their products. So you can't do this conversion when you have to manually process every transaction. Now, if you think about it, WhatsApp already has an incredibly high penetration rate across the continent. For example, in Kenya, 97% of mobile phone users use it. It's 96% in South Africa and 95% in Nigeria. So why on earth would you build a website, an app, or some other checkout flow and then beg the customer to switch from your content channel to your sales channel? So what Nile has done is they filled the void with the only design that works locally, integrating the full shopping journey from product discovery to secure checkout directly into WhatsApp and Instagram DMs. And they even use an AI assistant called Sabrina, who handles discovery, queries, and payments, but it's all in a single chat experience in WhatsApp. There's no app to download, no redirect, no abandoned cart. The store opens inside the trusted platform that exists already. So if you think about this, it means that Africa is skipping the traditional e-commerce model entirely and moving directly from chat into commerce. They call it conversational commerce. In other words, websites are so 2010. AdBot, another company, illustrates a similar point very neatly. What AdBot does is it sells Google advertising to small businesses. And at the back, they create simple workflows across the entire ecosystem, from search to maps to streaming to chatbots. And then they improve click-through rates, and they use AI automation to substantially reduce marketing costs for small businesses. So what used to take an ad agency a week, a small outfit can do with AdBot in an hour. But the thing is, small businesses in Nigeria don't have cards to pay for these services. Enter MTN. Instead of waiting for PayPal or Stripe to gain traction in Nigeria, AdBot partnered with MTN Nigeria to let business owners pay for online advertising using airtime. So the barrier was never that these businesses couldn't afford to advertise. It was just that nobody would accept the money that they actually carry. In other words, the innovation here isn't the ad engine, although I think it's pretty cool. It was the humility to accept the currency in the customer's hand instead of insisting on a fancy payment channel that works everywhere else in the world. So, part 2, don't try and be the bank. Sit behind it. This is the architectural pattern under almost everything that works here. So let me make that explicit. The customer faces a licensed entity that they already trust, which is a bank, a mobile operator, or a wallet. And in Africa, all those wallets are issued by telcos. So the entity owns the license to operate and the relationship with the customer. So for a new startup fintech company to succeed, it should sit behind it, carrying the technology and often the risk, and the customer never sees them at all. So it's essentially a very sophisticated back office. It's unglamorous, so you don't get a logo on the billboard, but you also don't need a banking license, a branch network, or anyone's permission to exist. Optasia is the purest example. Optasia distributes more than $13 million per day across over 32 million loan transactions. I mean, just 32 million loan transactions. If you work that out, that's roughly 40 US cents per loan on average. There's no conventional lender in the world that can underwrite at those economics. And they lend these amounts to people who have no credit history that are approved in seconds. No 24 to 72-hour risk assessment, no pay slips, no bank statements, utility bills, or a stamped affidavit saying that they're an exceedingly responsible borrower. But here's the trick. Optasia isn't the lender on record. The mobile operator or the registered financial institution behind it is. What Optasia does provide is a credit scoring brain, which builds AI and feature engineering decisioning layer on top of the mobile network operated data lake. It's not magic. It's the observation that how someone uses their phone, for example, how regularly they top up airtime, whether their data usage is consistent or erratic, whether they receive calls from many different numbers or a reliable few. And these insights reveal a great deal about the financial reliability of customers, but things that banks don't know at all. So they approve in 30 seconds, and they generate this enormous lending volume without any of the capital or licenses that this normally requires. The model lowers the cost to serve for customer segments that a traditional banking model could never, ever economically serve at scale. And here's the kicker. Their default rate is an industry-leading 1.2% to the supposedly unbankable. So the disciplinary mechanism is elegantly brutal. Default, and you lose access to the only credit you can get. It turns out that this threat of exclusion is a more powerful enforcement tool than a 6-foot sheriff who knows where you live. The unbankable, it turns out, pay you back. And the market loved this idea. In November, Optasia listed in Joburg in the largest FinTech IPO that the country or the continent has ever seen. And they're very, very proud to also now have FirstRand as a strategic partner. Then the phone is the terminal. So my PIN pad asked a similar question from the other side of the counter. So you and I may not think twice about a point-of-sale terminal, but it costs a fortune. It requires a merchant agreement, a complicated installation, and regular visits from a field technician whose availability, at best, is theoretical. For 600 million Africans living in areas where formal banking infrastructure is thin, the point-of-sale terminal is not an inconvenience, it simply doesn't exist. But smartphones are everywhere. So my PIN pad turns the phone into the merchant that already owns the smartphone into a card terminal. And rather than fight the banks for the merchant's loyalty, what my PIN pad has done is they've white-labeled their service to all the banks. That way, they don't even have to go to war to acquire customers. They can just sit back and sell the weapons to the banks. They don't get any glory, but they do get the business. And then there's PowerTech, 1,800 a second. They run the payment and engagement layer behind mobile gaming. It's 1,800 wallet transactions per second. And they're built for the cheap phone and the unreliable network. And they accept exactly one payment method, which is mobile money. So it sounds like a limitation until you realize that is the key that opens the entire informal economy, the big part of the market with no cards at all. And I know it sounds simple until you realize that to accept mobile money in Africa, you need to do perhaps 50 separate payment rail integrations. And true to the pattern, what these guys have is no license, they touch no float, local partners carry that. PowerTech carries only the technology. So Optasia, PowerTech, my PIN pad, none of them built their own front door. Part 3, and this is the one I care about most. The constraint is the moat. Here's a constraint that ought to be embarrassing and one that nobody ever thinks about. Until 2025, a card payment between two people standing on the same street in Lagos was very likely cleared through service in America or Europe. It meant the fees were paid in dollars. There were currency conversions, transaction data that sat in somebody else's jurisdiction. And so African payments were leaving Africa just to come back. And everybody described this as a problem of infrastructure. The interesting companies saw it as a moat with no owner, a piece of territory that nobody had bothered to claim. So in June 2025, Mercury, the African Import-Export Bank, and PAPS, which is a long word, but it stands for Pan-African Payment and Settlement System, launched a so-called PAPS card. I do think they can get a better brand. But this is the first card scheme that clears African payments inside Africa. Now, building a card scheme, that's not an easy thing. It's not a hackathon project. It takes years of certification, regulator sign-off, central bank participation, bank-by-bank integration, and standard documents that are enough to stop a door. But that's precisely why this is defensible. You cannot outfund paperwork, and you cannot disrupt a certification. So the moat here is actually the pure boredom of the work. And boredom, it turns out, is a very hard thing for a competitor to copy. And my PIN pad, remember them, the phone as a terminal people, they've got the same moat for the same reason. Standard point-of-sale systems are tightly regulated and certified by payment card industry with hardware-level safeguards. Software-based POS, by contrast, has to secure a device that was never meant for payments, which is the ordinary smartphone. So the document describing the technical requirements here runs to over 100 pages and includes provision for detecting developer mode, preventing side-by-side channel attacks on PIN entry, and many other technical vulnerabilities that are not immediately obvious to anyone who hasn't spent years thinking about how to attack a payment terminal. So of course this was hard work. It took 5 years. And by the time my PIN pad were done, they had every certification in the book for mobile payments on commercial, off-the-shelf devices. Now today, a well-funded competitor with a brilliant team can vibe code the SoftPOS software in a week, if they like living dangerously. But they still need those same 5 years for certification. You cannot pay to skip that. So the thing that made it nearly impossible to build is the very thing that makes it nearly impossible to copy. And then there's Bank Zero. Oh, I'm sorry, I'm going the wrong direction here. Oh, here we go. So there are lots of things about Bank Zero, modern technology, different business models, single channel exposure. But one of the constraints that they solved for was straight back down to the license itself. So instead of using a full commercial banking license, they used a mutual bank license, which requires about 25 times less capital. So that's the entire strategy, a bank with a cost base that's perhaps 1,000 times lower than a traditional one. The deliberately doesn't offer credit, no lending, but it can do transactions at a percentage of the cost, which means it can actually charge it at zero and make some money out of the interchange. So no clever app, just an ultra low-cost business model. So, part 4, keep the economics radical. There were roughly 92 billion mobile money transactions in Africa last year, each worth on average $15, or that's just over 250 Rand. There's no data on this, but the transaction value distribution probably looks something like this. It means the upper limit can be high, but most transactions, therefore, are smaller than the average. Recall, in Optasia's case, the average loan size was 40 US cents, for example. So you have high transaction volume involving what are often very small amounts. That means two things. First, if your cost per transaction has even a little bit of fat in it, the volume doesn't save you, it actually bankrupts you faster. Second, anything that depends on a fat margin per transaction was never going to survive here in Africa. So the volume is both a gift and a guillotine. And the companies that live treat every fraction of a cent as if it's the only thing that matters, because it is. And then there's Zaru. Now what happens here is that any traditional payment rail simply breaks at very small amounts. It's one of those issues that sounds quite theoretical. until you try to pay a machine 5 cents for a service, and you find out that the transaction fee is 15 cents. At that point, it becomes acutely practical. So the payment rails that were designed for the whole world in 1960 for meaningful amounts don't work at all for so-called agentic micropayments. But stablecoin rails on modern blockchain networks resolve this. A transaction on Solana costs approximately 0.0005 American cents, which is about 1% of a 5-cent payment rather than 300%. So this is a very interesting infrastructure gap that makes agentic commerce, which is AI systems that autonomously transact with other AI systems, technically feasible at micro scale. ZARU, or the Universal Rand Network, is a Rand-denominated stablecoin. It was launched in Feb by a consortium of major financial institutions. It includes Luno, Sanlam, Easy Equities, and Lusaka Technologies. It's pegged 1-to-1 to the Rand, and it's backed by high-quality liquid assets such as bank deposits and South African government bonds. And then monthly audits conducted by Moore in Johannesburg. So it makes genuine sense, but only for the right job. The defensible territory here is domestic Rand payment automation, like gig worker payouts, supplier settlements, energy micropayments, or automated insurance claim. Unlike dollar-based digital payment rails, it avoids any currency risk into transactions that are entirely local in character. Of course, in cross-border, dollar stablecoins have already won. So pretending otherwise is how you would light money on fire. So you've got to know exactly which constraint you're solving and don't wander into the one that you're not. Which brings us to a number that nobody at a FinTech conference wants to mention or say out loud. So even in a mature ecosystem, like the ones where Lusaka Technologies operates in Africa, with around 270 billion a year flowing through it, roughly 44% of all of that is still cash. And this is after all the apps, after all the wallets, all the disruption, cash. The fact is simply that people will continue using cash for a number of good reasons. Avoiding tax, avoiding fees, avoiding technology they don't understand, or simply because that's what they've always used. Now you can treat this as a failure of digitization and wait for it to disappear, or you can simply treat it as a simple description of the economy in which you're operating and build for it. Digitize the cash, serve the spaza shop, meet the customer as they actually are. So Lusaka chose to route around cash instead of fighting it. Lusaka point of sale terminals and spaza shops are the bridge. So they let a micro merchant process value-added service transactions and cash all without a bank account. It supports them with business advice, microloans, and a bookkeeping back end. It gives them insight into the merchants as well as their customers, and it became the leading digital commerce service provider in this market in Africa by doing so. So the companies that try to change the customer too much lose to the companies that simply serve them as they are. And then there's CrossFin, which in a sense is the cherry on top. So how often have people spitballed ideas only to hear, this will work in a big market like the States, but the market just is too small here. Sure, keep complaining because that'll just make the market even bigger. Or you can just rethink how you approach the market. In venture capital, which is kind of my game when I'm not trying to make wine, the received wisdom is to try and pick winners. You back the best founder with the most audacious vision, hand them a check, and wait for them to disrupt everything. But in FinTech in Africa, I've learned that you'll get burnt doing that. Instead, you back 12 reasonably good founders and watch them build 12 slightly different versions of the same payment terminal, and then you quietly buy all of them. So that roughly is the CrossFin thesis. South Africa's FinTech market is large enough to generate interesting problems, but not quite large enough to sustain 30 competing micro-solutions to the same problem. So the inevitable conclusion is consolidation. They'll consolidate. Now, the CrossFin portfolio reads like a sweep of the payment stack, which is Adumo for merchant acquiring, Lusaka for the Spaza shop, an informal retail channel, Cybrant for banking software, Innovation for switching, TrueID for open banking, Troy Gold and Yo-Yo for loyalty and rewards, Mercury for card issuing. So each asset individually is a respectable niche business, but together they form something considerably harder to replicate or undercut. The Adumo into Lusaka transaction is a proof of the concept. Adumo had 23,000 merchants. They were producing 24 billion in annual throughput. But most of these merchants were never before served by any formal acquiring infrastructure. So after this acquisition, which was worth 1.6 billion, Lusaka's ecosystem represented a 270 billion flow through 120,000 merchants. And it also provided an exit for Adumo shareholders onto both the JSE and the Nasdaq. So the opportunity here wasn't stealing share from an existing competitor, it was in consolidation. So again, I want to make the point that in these fragmented markets with thin margins and small average transaction values, the roll-up operator who can build and consolidate a fragmented market outperforms the pure venture capital bet. You don't always need to invent something new. You just need to be the last one standing when everybody else runs out of runway. So if you keep forgetting everything else, keep 3 sentences. 1, distribution is destiny. The winners rode existing distribution networks. Optasia rides the mobile network. Powertech rides mobile money. Clickatel rides WhatsApp. Adbot rides the SME's airtime balance. Mercury rides national payment switches. None of them tried to build their own front door. 2, capital structure is the product. Bank Zero's mutual license. Optasia's bank guarantee, not balance sheet model. CrossFin's roll-up thesis. Zaru's rand pegging. In other words, the financial design choice often matters a lot more than the technology choice. And then thirdly, the constraint is the moat. No credit cards forced about 200 different mobile money services. Having no card scheme forced PAPS card. Having no high-end phones forced USSD banking. Having no point-of-sale terminals forced soft POS. Having no bank accounts forced chat banking. So African fintech that wins is a fintech that designed for the constraint instead of waiting for the constraint to disappear. Every one of these companies was built on the exact thing that everybody thought would sink it. So finally, what happens when these markets mature? Now, successful fintechs create valuable middleware for the banks and the mobile network operators that I said they should sit behind. They do things like orchestration, merchant acquiring, credit scoring, fraud detection, cash digitization, wallet interoperability, embedded payments, and more. But what happens when these big incumbents, the banks and the telcos, decide to rebuild or internalize that layer? So it turns out that the exact same moat that protects these fintechs from would-be competitors are the same moats that make it difficult and far more valuable to be acquired. And as a venture capitalist, I do like higher valuations. Now, historically, the banks and the operators in Africa have not been great acquirers or integrators of fintech assets. They can buy the technology, but they often struggle to preserve the product velocity, the engineering culture, the field execution, and the customer obsession that made the fintech valuable in the first place. That suggests a useful maturity curve. So in the early market, the fintechs win by doing the ugly, difficult middleware work that the incumbents ignore. In the growth market, banks and the mobile network operators partner because a fintech solves distribution or the cost to service better than they can in their own. In the maturing markets, incumbents then try to internalize the layer, but they often underestimate how much the moat is operational, not just about technology. And then in the consolidated market, the winners are either acquired at a premium or they become profitable platforms themselves, and sometimes remain a neutral infrastructure layer. So the reward goes to the boring. Or if I can't say so, boring banking or boring fintech is sexy. So this is just me being honest, because I suspect this is a fairly cynical room and you'll respect the honesty. But the winners are the most boring ones. They're the companies that are willing to navigate local bureaucracy and earn certifications. The companies that can partner well. The work may be unglamorous, but it is quietly enormous. The demo that wins rooms at conferences is really the business that wins in the real market out there. But the good news is that hard work is a temperament. And if you've survived in Africa for a while, you'll have a hard-working, self-reliant temperament in abundance. Africa didn't get a worse version of Western FinTech. It was forced to build the workaround. And in some ways, the workarounds turned out to be the better business. The constraint was not the problem, it was the moat. And adapting to these constraints has nurtured operating models that in time could become world-leading. Why do I say that? Because the world is becoming mobile first, conversational, AI-assisted, embedded, decentralized, and infrastructure light. Nobody can afford the cost structures anymore. And in Africa, we've never tolerated them. So what did Sinatra say? If you can make it here, you'll make it anywhere. So instead of viewing Africa as lagging, a market where FinTech faces too many obstacles, I see it as ahead of the curve, because we were forced to solve tomorrow's problems yesterday. Thank you very much.
It's a real pleasure to be moderating this session with Michael. I think, firstly, as a digital leader in F&B and making F&B a digital leader, to now backing and building some of the most exciting African fintechs.
And making wine.
And making wine. So you've definitely had quite the journey, including the wine. And I think what makes today's conversation particularly interesting, as you've alluded to, is or through your presentation, is you're a very rare breed with operational experience and now investment experience. So I'm sure the audience is going to have lots of questions, and already some good ones coming through. So please keep sending them. And while they come through, I'd like to start with one of my own. You've touched on where you see the more favorable parts, but I'd say if you were allocating capital today as a CIO, bearing in mind lots of investment professionals in the room and online, where in the stack do you think the opportunities lie most easily? So distribution, rails, underwriting. Someone mentioned AI in the questions already. Unfortunately, we at Intengo aren't raising funding, so you can't choose our infrastructure as the obvious answer. But where would you look to first?
So as I mentioned at the outset, I've just kind of been opportunistic. The grand thesis, if I can call it that, I spoke about it today, kind of only dawned on me afterwards. But clearly, without distribution, nothing can work. There's this old saying where they said, what's going to happen with the race between startups and incumbents? And it'll be whether the incumbent gets innovation before the startup gets distribution. And that's the big race of our time. And it sounds easy, like all startups have distribution, right? Don't they? They have apps and so on, and they have the internet. But it's not true in Africa. You need the bank or the telco operator as distribution. If you have the ability to invest in that distribution, I think that is super powerful. So I would put that as number one. What I would put last is merchant acceptance. And that's just because, the cards don't exist yet. And then in between there, you can argue about the others, the rails. What I would say about the rails, though, it's got to be very, very low cost. Got to completely rethink the way it is. Again, in line with what I said, the average values are very low, so your margin just has to be low. I think there's an example, of a spaza shop where you buy like one sachet to wash your hair or one cigarette at a time. You have to think the same way in financial services. Optasia does loans at 40 cents for an average loan. It's just something that wouldn't have been possible 15 years ago, but it's also not the way that we traditionally think about financial services.
No, certainly not. I think those microeconomics are quite staggering when you think of it that way. It wouldn't be a fintech discussion with some reference to AI, so we'll start there. And I think on the theme of moats, someone has asked, how do you distinguish between businesses where AI creates a genuine competitive advantage and those where it just lowers barriers to entry and intensifies competition?
Okay, so the AI is obviously the biggest theme in investment everywhere. Which parts of the businesses will most be affected by AI? Every part. Which industries will be affected by AI? Every single industry. I think I'm going to divert my answer by saying I think the ones that are likely to win are just the ones who have the right culture to internalize it the most. But we are entering a completely new world where, the winners take most, if not everything. So what you can say without a doubt is that there are going to be businesses in 10 years' time that are completely AI businesses, and the others are going to be dead. That's for certain. But I think what I'm not doing is answering questions to say like exactly how to deploy the AI. And my view there is that no one really knows yet. What we do know is that if you don't embrace AI, you won't be around.
No, fair point. I think it has to be on any topic of conversation in the FinTech. So on the flip side of advanced technology, what is the future of central banks in the world you describe?
There's a lot of criticism around central banks. Did they handle the financial crisis correctly? Did they maybe cause, the mortgage mistakes that happened? Did they inject too much liquidity? Even now, you've got these massive imbalances in the world. But it's very difficult to imagine a world without them. The opportunity cost if there weren't central banks. I mean, they still have massive credibility. The most important price in the economy, by far, is the price of money, interest rates, which they set. But here's the thing where central banks and existing banks are being challenged, and it is actually by cryptocurrencies and stablecoins. So cryptocurrencies can do settlements across the world in an instant, real-time online. And similarly, I don't think money has ever had a challenge the way that central banks may in future be challenged by other currencies that are no longer issued by central banks. I'm a bit of a conservative economist. I think central banks are going to hang around for much, much longer than people think because the system does actually work. So you need to use all these new currencies to solve new problems. I tried to make the point earlier that stablecoins, I don't think people are going to use stablecoins that quickly to shop at Pick and Pay because the existing system on cards works so well. But they may very well work when you sell your electric power to your neighbor at fractions of a cent. So I believe in our lifetime, central banks are still going to remain very powerful.
Yeah, and as you say, it's more about the rails at the end of the day, at that low cost of the rail that maybe a stablecoin can use rather than 100%. The coin itself.
You need to go back to first principles and see what you want to achieve. So you want rails at low cost that can do things at high volumes instantaneously. So for example, where our payment system is deficient in South Africa is if you make a payment on a Friday, nothing happens on the Saturday and Sunday, and it may arrive the Monday or the Tuesday. That is crazy in a world where you can, transfer a cryptocurrency and it arrives at somebody in a second. So payments should happen, 7 days a week, 24 hours a day, and you can expand that to things like exchanges, for example. It shouldn't just be open certain work days. All the important commodities in the world, oil, gold, etc. These should be continuous markets.
We're gonna change track slightly, and these questions are anonymous, but so we don't know if this was someone from FirstRand, but how do you think a company like Pepkor, with 6,500 branches and 135,000 flash merchants, will compete in South Africa's fintech space with the bank they plan to launch? Are they able to compete with the incumbents?
Gordon Moore, who wrote Only the Paranoid Survive, one of the founders of Intel. I think I read it as a school kid still, and it impressed me hugely is you've got to be paranoid about competition. And if I were a bank, I would be paranoid about Pep if they get it right. They're very good executors, just in general. They're very good at low cost. They have the distribution network across the country. They have the brand. They have the customers. More importantly, they sell, I'm going to get the figure wrong, but many millions of phones per year. Could it be 13 million? Now, if I were them, what I'd do is I'd I'd put a banking app on the phone that I distribute, and through the RICA that you do, the custom identification, you would do the FICA as well. So there every phone can become a bank account. Of course, I think the biggest threat here would probably be to Capitec. But I think you've got very real competition. Of course, this is very exciting for consumers. That's what competition does. So there's a very exciting future for consumers in South Africa with all the battles that are happening there.
We'll squeeze one question in before everyone wants to get to lunch, and a nice easy one to finish. Do you use Claude or another AI tool, and why?
So I really am a hillbilly, and I'm getting old, so I actually had a youngster who's really good come in and give me classes on AI. I recommend that. So I had 6 sessions of an hour each on Claude. I now have a health agent, because health is important. I have a PA, who kind of does everything for me, and I have a business partner into which I've uploaded all my documents using a separate database called Notion, and it is the coolest thing ever. So I use Claude, but I sometimes do double check with Gemini, and then for up-to-date things, I use Grok. And sometimes I have debates with each other. But I feel like Asterix with Magic Potion. It's completely changed the world for me.
No, great. Well, thanks, Michael. And on behalf of everyone, thanks for your insights.
Thank you for listening.
Cheers. Thanks, Michael.